Good morning for those of you in the central or further west time zones, and good afternoon to those of you on the east. Thank you for joining us for our webinar, Executive Compensation, ERISA, and Employee Benefits Issues in M&A, What You Need to Know. My name is Andy Daly. I am the Vice Chair of the Tax and Employee Benefits Practice Group here at Saul Ewing, and I'm joined today by my partner, Adam Cantor, who is also a member of the Tax and Employee Benefits Group. Excuse me. Before we begin, just a couple of fun housekeeping announcements. We will be using the Q&A feature. So if you look in your Zoom window and see the Q&A feature, please feel free to submit questions at any time. We will try to get to all of them. If we can't, we'll try to follow up with you by email after the fact. We may get to some of them as we go along, so feel free to enter questions as you have them. Some of them will be waiting until the end to take up. This program has been approved for one substantive CLE credit in Delaware, Florida, Illinois, Minnesota, New Jersey, New York, and Pennsylvania. And we also have applications pending in Virginia and California. As a CLE provider, we must be able to verify your attendance. So at a couple of random points during the presentation, we will display and I will verbally mention 2 numeric reporting codes. So please copy those down if you want CLE credit. You'll get a survey afterwards where you'll be asked to enter those 2 codes. If you enter those 2 codes, you will get your CLE credit. That should come out within 5 days of the program. We are recording this webinar. So following the webinar, you'll receive an email, and that email will include a link to the recording and a link to the presentation materials. So you will all receive a copy of these presentation materials as well. And of course, the fun legal disclaimer: the provision and receipt of the information in this program is not legal advice, does not create a lawyer-client relationship, and should not be acted on without seeking professional counsel who have been informed on the specific facts of the matter. So with that, let's begin. Here's a quick table of contents of what we're going to cover today. Part 1 is going to be an introduction of generally the topics that we're going to cover. Then we'll get into the specific details of executive equity and deferred compensation issues. Part 3 will cover ERISA, the Employee Retirement Income Security Act. And Part 4 is our David Letterman style top 10 list of things to watch for in M&A deals. Next slide, please. So in the introduction section, here's what we're going to go over the topics on the screen here. I'm not going to read them all, but we'll just jump right into it. So when we talk about executive compensation, that can mean a lot of different things, but essentially we're really talking about any compensation that is payable for services rendered by key employees, officers of the company, directors, can be independent contractors as well. And so some of the forms that we're talking about, annual bonuses are a very common one, and long-term incentive plan bonuses. Oftentimes those are time vested, which just means you stick around, you remain employed, you get paid. And oftentimes for executives, they're performance vested, and so they're triggered by hitting certain metrics, typically financial metrics, but not necessarily financial metrics, and are paid based upon on those performance targets. Deferred compensation, again, we'll get into this in more detail, but when we're talking about deferred compensation, we're really talking about any compensation that's earned in one year and paid in a later year. Equity compensation, so the most commonly heard of are probably stock options, but there's also others: restricted stock units, profits interest in an LLC. And we'll get into those in a little bit more detail as we go along. Change in control payment, very common for companies that are looking to sell. And so a key feature of M&A transactions is a change in control payment, whether it's something that's issued in contemplation of a pending transaction to keep people in place, or whether it's something that's more of an incentive to build value over time. Severance payment, that's also a common one if an executive is terminated without cause. salary continuation. The next one, retiree medical, same thing, but for medical benefits, and then perks, the company car, housing allowance, those sorts of things that you're just providing to top executives. Okay, next. And what is ERISA, our second topic? So ERISA refers to the Employee Retirement Income Security Act of 1974. And so, yes, it has been around for a while now and has been amended over the years many times. And when we're talking about ERISA, we're talking about a plan. And so what a plan means, it's a little bit more nuanced than whether it says plan in the title or whether there's multiple participants. A plan can exist with just one participant in certain circumstances. And so a plan is really about whether the company maintains an ongoing administrative scheme with respect to the benefits provided to employees. And a good case to highlight this is severance. In some cases, severance is a plan that is subject to ERISA. In some cases, it's not. And there are certain circumstances where you want it to be a plan. So, for example, if you have employees in a bunch of different states, if the plan is subject to ERISA, you generally don't have to worry about the laws that are specific to individuals throughout the country, because the plan is going to be preempted by ERISA and subject to federal law provided under ERISA. Next slide, please. And so this slide shows kind of the key factors of how you determine whether a severance plan is subject to ERISA or not. And so if you've got one reduction in force, RIF there, for those who don't know, means reduction in force. It could be a mass layoff or a group of terminations more than one at a time. A one-off is generally not going to be an ERISA plan, but if you've got severance applying to multiple people at multiple times, if it's one single RIF, might not constitute an ongoing administrative scheme. But if you've got several different RIFs and or it's going over a long period of time, you're moving closer to being subject to ERISA. Who's eligible? If it's discretionary eligibility rather than specific classes, then you might have an ERISA ongoing administrative scheme or a plan. And what does the benefit formula look like, and how is it paid out? If you just got a simple 1 week of salary continuation for each year of service and it's all paid in a lump sum, probably doesn't require an administrative scheme. But the further you get from that, the more likely you're going to be under ERISA, which again isn't necessarily a bad thing. So on the next slide, we'll get into common types of ERISA plans. 401k plan, you're probably all or most of you are familiar with a 401k plan. Also, employer contributions in the 401k plan, whether they're matching contributions or profit sharing. Employee stock ownership plans or ESOPs. Those are all types of deferred contribution plans in which your retirement benefit is whatever your account statement says it is, as opposed to a defined benefit pension plan, where your benefits under the plan are going to be determined by the plan and be a fixed amount, where the company may have funding shortfalls that it needs to overcome. And so those plans are not as common as they once were. A multi-employer pension plan, when you see multi-employer as one word, that's referring to a plan for union employees. And often, it's going to be benefits provided under a collective bargaining agreement. And with a separate type of plan, oftentimes a company will have a company that has both union and non-union employees. You might often see one plan for union employees and a separate plan for non-union employees. Deferred compensation plans can be subject to ERISA, at least some provisions in ERISA. Typically, if you hear the term top hat plan, it's a deferred compensation plan subject to ERISA, but it's just benefiting certain key employees or highly compensated employees. And then you don't have to follow all of the restrictions in ERISA, 5,500 filings, for example. Severance plans, which we just talked about. Bonus plans. So a bonus plan can be subject to ERISA. Your annual bonus plan is almost certainly not going to be subject to ERISA, but if payment is systematically deferred to termination of employment or beyond, or retirement, you might have a top hat plan in that case, and then you have to watch for certain restrictions about participation and other ERISA concerns. And then your health and welfare plans, which the most common, of course, would be a health insurance health plan, dental plan, life, vision, long-term disability, short-term disability, cafeteria plan, those sorts of plans fall in here. And so what is ERISA? What happens if ERISA applies? So fiduciary liability is a big one, which can mean personal liability on the plan fiduciaries. And so, of course, who is a fiduciary? The plan administrator, which is typically the employer, unless it's delegated to perhaps a committee of the board, is going to be a fiduciary. The trustee of the plan is going to be a fiduciary. But fiduciary is really about what type of acts you're performing. So the trustee of the plan isn't, every act of a plan trustee is not fiduciary in nature. And there can be those who don't have a designated fiduciary role that are performing fiduciary actions. So looking into ERISA fiduciary liability coverage is something you should be thinking about if you've got concerns about ERISA fiduciary liability. Funding, got to have a funding mechanism for the plan, and make sure all the plan assets and benefits stay within the plan and are distributed according to the terms of the plan. Participation and non-discrimination, who needs to participate at what level and who can be excluded under the rules. Vesting, under your retirement plans, for example, there's often going to be a vesting schedule. So any employer contributions you're going to have to work for a number of years before you're 100% vested. In other words, you don't have any amount of your employer contributions subject to forfeiture. Reporting and disclosure, that's going to be your Form 5500, perhaps a plan audit if you've got over 100 employees. Summary annual report, summary plan description, participant statements, those sorts of things. And then a claims review. ERISA has its own administrative review process. And so any ERISA plan should have a claims procedure in it. And if any participant has a claim against the plan for benefits, different benefits, more benefits, we're not talking about just your 401k distribution request, but we're talking about situations where an employee thinks that they have a right to more benefits than perhaps the plan statement does, the participant statement does, or the plan administrator says. And so there's specific steps that need to be followed. And if those steps are followed by the employer, the employee would need to, or plan participant would need to exhaust that claims procedure before he or she could file a lawsuit. And then typically the lawsuit is going to be limited in scope to the findings and the information from that claims procedure. So this can be a very helpful thing in kind of expediting that process. And then preemption is simply if a plan is subject to ERISA, it's subject to ERISA and not state laws. And so ERISA would preempt any state laws. And for those of you who are looking for CLE credit, if you haven't noticed on the slide here, CLE code number 1 of 2 is on the slide here, 53211. CLE code number 1 is 53211. Okay, and then on the next slide, there are a lot of employment issues that implicate ERISA and some of these executive compensation matters that we've discussed. And so the employment classification, properly classifying your service providers as employees or independent contractors. In some cases, it matters a lot. For example, an independent contractor can't participate in your 401k plan. In some cases, it's not as important with certain forms of deferred compensation. Union versus non-union, different rules apply under ERISA and under collective bargaining agreement for union employees. Covenants not to compete, which have changed significantly over the years, can also come into play with your executive compensation issues. Same with other restricted covenants like non-solicitation and confidentiality. The WARN Act mentioned earlier, reductions in force, and so if you're laying off a large enough number of employees, you've got to watch for WARN Act. Age Discrimination Employment Act, on those severance agreements, if you've got a release, those sorts of things, you've got to watch for that, and HIPAA, of course, keeping personal health information confidential. Okay, and so when we get into M&A, there's generally 2 types of transactions: an asset deal and a stock deal. They are what they sound like. An asset deal, the the buyer is typically buying the business, but they're not buying the equity of the company. And so they're usually buying all or mostly all of the assets of the company and assuming certain liabilities. There are exceptions, and so the asset purchase agreement is going to specify which assets are included and excluded, which liabilities are assumed and not assumed. And employment's not automatic, so the buyer is going to have to decide which employees to hire and which benefit plans to continue or assume. That generally, the benefit plans are going to stay with the seller unless the parties agree that the buyer is going to assume them. And typically, they're not assumed by the buyer, but there are certain circumstances where it makes sense. Maybe the seller has a plan where the buyer doesn't, for example. And so those are typically going to remain with the seller as excluded liabilities. And next, in contrast to stock deal, you're buying everything. So you're buying the stock of the company, and along with the stock comes all of the assets, all of the liabilities. And so certain things can be carved out in the stock purchase agreement, but the default is that everything is included. And so the buyer is going to assume the benefit plans unless those benefit plans are specifically carved out. Oftentimes that means that they would be terminated prior to closing. But those are the sort of things that you need to watch for and understand in the due diligence process: what plans exist, what benefits exist, what compensation arrangements, whether they're formal or informal, exist. And then you also have to watch for related company issues and making sure that you're aware of if there's whether it's a stock deal or an asset deal, if you've got multiple related employers, which ones are involved, where the benefit plans belong, who's the sponsor. And so making sure you have a good understanding of those issues as well. And so on the next slide, why should we care? Well, due diligence on these benefit plans is very important because executive compensation, ERISA, and employment issues can be expensive and complicated. And so figuring out what you have and how it can be addressed before they become an issue can save you a lot of headaches and cost. Maybe an adjustment of the purchase price is warranted. The reps and warranties and covenants, do they adequately protect the buyer? Are they have, to the extent that there's potential losses in these plans or costs in these plans or errors in these plans, are we protected against something that's discovered after the fact? And the post-transaction operation of the buyer and target, what happens to plans and compensation arrangements in a change in control? Does that trigger payment? Do those arrangements go away? Are they assumed by the buyer? What does the agreement say on that? Because it's not always as simple as, well, we just want this to go away and we're just going to pay it. That can also have negative tax consequences. Okay, next slide, please. And so representations, warranties, and covenants, what you're really trying to get at there is, are there losses, costs that are not known? And so the seller is typically going to make all these representations and warranties about the benefit plans, and not all of these things are known. And so this isn't really about finding bad actors. It's about finding unknown liabilities. And so making sure that you're adequately covered. Sometimes there's a small deal that has big hidden costs. So it's really just important to watch for, do your due diligence, find out what potential issues there are, and make a smart business decision about what these representations and warranties are going to look like. Next. And so if there's a breach of a representation or warranty covenant, indemnification is typically going to be one of your primary lines of defense. Due to time constraints, we're not going to go into great detail on indemnification today, but we did want to include it in the materials. And so watch for these sorts of things. Oftentimes, or at a lot of transactions now, representation and warranty insurance is becoming more common. But again, that's not a perfect solution either. And so you can skip ahead a couple of slides here, and so the key things here, just watch for the survival period of the indemnification? Does it go to the statute of limitations or not? Things like the basket, which is kind of a deductible for purpose of indemnification, whether the losses are going to be covered just in excess of the deductible or the basket, or whether once you hit that number, if everything's going to be covered. That might be referred to as a first dollar hurdle or a tipping basket. And then caps. There's often going to be a cap based on a percentage of the purchase price on indemnification. So then what happens when the deal is done? You really get into the process of integration at that time, and what benefit plans you've taken on, continuing those, administering those alongside the ones you have, and to the extent that you haven't taken on benefit plans, integrating new employees, and making sure that you're watching for, in certain circumstances, there might be deferred purchase price that may impact some of your deferred compensation agreements, and so making sure that you follow the terms of those agreements. All right, now we're going to move into part two, executive compensation issues. I'm going to cover the first couple of topics, and then I'm going to turn it over to my colleague here, Adam Cantor, who's going to take it from there. And so the next slide kind of lists a bunch of the different types of awards. And so restricted stock, including performance shares, that's really a current grant of stock, but it's subject to a vesting schedule. So the vesting schedule may just be retention based. So if you remain employed, the risk of forfeiture goes away, and you then hold those shares free and clear. Those shares are going to be taxable to you when those vesting conditions have been satisfied, unless you file an 83B election, which Adam's going to get into in a moment. Restricted stock units are kind of I guess I think of them kind of as a hybrid of restricted stock and stock options, or stock options without an exercise price. It's really a promise to make a payment in stock in the future. Phantom stock is similar, where you're in some cases restricted stock units pay cash rather than stock, similar to phantom stock, where you're just paying somebody a cash payment equal to the value of stock. Phantom stock can either be the full value of a share or the appreciation in the share. Stock options, you've got non-qualified stock options and incentive stock options. The differences there are really just there's certain additional restrictions for incentive stock options or ISOs in terms of who can receive them and how many incentive stock options you can get. Only employees can receive ISOs. And the main difference is tax related, where ISOs, there's not ordinary income tax on the exercise of the options. Unless you have a disqualified disposition, which would mean selling the shares received with the option before you've held the shares for 1 year or within 2 years of the grant date. Stock appreciation rights are kind of what they sound like. You get a grant today, and the grant will stay the value of the shares, and then when you exercise or are paid, you'll receive the difference in the value on that date minus the value on the grant date. And then deferred compensation, which we've already addressed. Generally, profits interests are kind of a more flexible LLC partnership form of an option, where they're just an appreciation. They share in the appreciation of the value of the company and have no value and have no. They don't share any portion of the value of the company that has accrued to the date of issuance or grant, and so they'll just share in the future profits and appreciation and the value of the equity of the company moving forward. Annual bonuses and long-term incentive plans, which we've already touched on. So, amending existing plans, you really have to watch out for what your plan says. There's some statutory requirements. Incentive stock options have to be approved by the board, not each grant, but the plan. They have to be granted under a plan. The amendment of any stock options, you have to really watch for whether it's a modification of the agreement of the option, and in certain circumstances, changing the exercise price can be an issue. Stock options that have an exercise price lower than the current fair market value of the shares can get you into trouble with 409A, section of the tax code that Adam's going to get into. And so, does the plan require shareholder approval for an amendment? For public companies, are there exchange rules that require shareholder approval for amendments? And oftentimes a plan is going to say, even for a private company, that if you're going to amend a stock option to reduce the exercise price that the value of the shares has gone down, which may or may not be a good idea depending on the circumstances, that may require shareholder approval, even if other amendments to outstanding stock options do not. And the ISO rules, incentive stock options, the board does have to approve the plan within 12 months before or after the plan has been adopted by the board. And an exemption for parachute payments, which we'll get into, that's on the next slide here. So parachute payments, or if you've heard of 280G, 280G is the section of the tax code where this comes into play. And so what we're talking about here is any sale of the company or change of control. And so if you have compensation that is contingent upon a change of control or relates to a change of control, you really need to be looking at this because the tax consequences are severe. We're talking about an additional 20% tax on the recipient and a loss of the deduction by the corporation. So if you've got a $1 million payment that's an excess parachute payment, $1 million, $200,000 tax on the individual and a loss of that $1 million deduction for the company. And so who does it apply to? Generally, just corporations, and C corporations at that. S corporations or corporations that are eligible to make an S election are generally exempt. Partnerships taxed, LLCs, partnerships taxed as a partnership, generally exempt. You do need to watch for corporate equity holders in those entities, though. So it's not quite as simple as that, but that's generally the rule, and it applies to both private and public companies. And so what we're talking about here is disqualified individuals, which are really the top people, executive officers, highest paid employees, highest shareholders, and shareholders. And so what is an excess parachute payment? The way to calculate it is relatively simple, in terms of it's relatively simple to calculate the amount of that would constitute a parachute payment. So it's simply 3 times the average 5-year taxable compensation. So you look at the W-2 for the past 5 years. There's rules about partial years in there, or if you haven't been around for 5 years, if I haven't been with the company for 5 years, but you take that 5-year average, multiply it by 3, and if you have parachute payments in excess of that, that's what we're talking about here. 3 times that. And so the next slide, please. And if you're the calculation of those parachute payments, though, is not quite as simple. And so that's where you really need to dig into the details. There may be some present value calculations in there as well, and the way that you look at stock options and other things like that, investing. But so if you've got payments that exceed 3 times that base amount, then everything that's in excess of 1 times is subject to that 20% penalty and non-deductible. And so if you've got a change of control with an average compensation of $500,000, and the employment agreement entitles the person to a change of control bonus of 1.5 million payable at closing, you've hit that 3 times there. So if you've got anything in excess of that, you've got an issue with 280G. And so how do you get around 280G? On the next slide, we'll talk about that a little bit. So in these circumstances, since you've hit that 3 times, then you've got excess parachute payments of $1 million. So that's where that $200,000 tax comes in. And that $1 million, the amount over 1 times the $500,000 base, is not deductible to the company. And so you've lost that tax deduction. You've got an additional excise tax, so it's very costly. And so if you're a private company, there may be a way out of this box. and that's with shareholder approval. If the executive in this case waives his or her right to that payment, and the shareholders thereafter say, we're going to reauthorize this payment, then that kind of takes away the taint of 280G, and you don't have the excise tax. It's deductible, but the executive truly does have to put it at risk and waive their right to it, and trust the shareholders to approve it. You can cut it back, and so in this case, if with the $500,000 base, if this amount was, for example, $1,499,000, then we don't have an issue. So they could waive the right to $1,000 and move on and just give that up. In that situation, not a big deal, but consider, what if this was $5 million and you'd be waiving the right to over $3.5 million. Best net is simply you compare what the individual ends up with after the 20% excise tax versus the cutback. A gross up would be, you've got the violation, you pay the 20% excise tax, and you gross up the individual to cover that excise tax. Obviously, it's very expensive because the company is that gross up is also taxable, also subject to the 20% excise tax, and not deductible by the company. And if you're a public company, there's additional considerations at play. And so I'm going to now turn it over to Adam. Thanks, Adam. Adam, you're on mute.
I guess that would be nice to get myself off mute. Good afternoon, everybody. So the key aspect when you're talking about executive compensation issues in M&A is and the key word is compensation. You're looking at remuneration for services performed. Sometimes they are past services, sometimes they're current, and sometimes they are future services. But you have to have a compensatory arrangement in order for the executive compensation issues to materialize. And the reason why I mention that is oftentimes in these deals, a key aspect of the deals is structuring the deal such that you can differentiate easily between what is purchase price for the stock or the assets, depending on the type of deal you have, differentiate that from what is compensation for services. And we're going to see how that plays out over the next several slides. So we just talked about 280G. And, to that point, 280G applies only if you have compensatory payments in connection or contingent on a change in control of the company. There's another statute that imposes or has the potential to impose another 20% tax on the employee, again, in addition to regular income taxes and FICA, Social Security, and state and local employment and income taxes. And that's Section 409A of the Internal Revenue Code. And that relates to deferred compensation. You might think that deferred compensation is a relatively simple concept, but it's the IRS we're talking about, so it's never that simple. The regulations under the statute are 397 pages long. Since the regulations were finalized in 2007, I believe there have been at least 20 sets of guidance interpreting the regulations. So we're dealing with a very complex statute. So when does Section 409A apply? First, you have to have a deferral of compensation, which the basic definition is a legally binding right to compensation that is or may be payable in a future year. So I work today, I perform services in 2023, and I may get compensated for that in 2024, or a subsequent year. That is deferred compensation in its simplest form. The regulations under 409A have exceptions for short-term deferrals. So if you perform services in 2023 and you get paid by March 15th of 2024, that's not a deferral subject to 409A. Stated differently, if you vest in the amount, like a bonus, if you vest in a bonus, let's say on December 31 of 2023, and the bonus is paid by March 15th of 2024, you're not subject to 409A. There's a nuance there that we'll get to in a second, but that's the general rule. There's also an exception for involuntary terminations without cause or bona fide good reason resignations, assuming that the payments are completed by the end of the second calendar year following the calendar year in which the termination or resignation occurs. So for good reason resignation or termination without cause in 2023, the payments would have to be completed by December 31 of 2025. And there's also a dollar limit to the amount that you can exclude under 409A. Generally, you're looking at least at this point, no more than $700K and change for 2023. There's also a key exemption for stock options. So incentive stock options, which can only be issued to employees and have to be set at fair market value, an exercise price at fair market value, sometimes 10% of fair market value, but certainly fair market value, those are always exempt from 409A. Non-qualified stock options, however, which can be issued to employees and independent contractors, consultants, members of the board of directors, those stock options, if they're issued at fair market value, meaning the exercise is no less than fair market value of an underlying share as of the grant date, typically are exempt from 409A. But there are some notable exceptions to that. You have to look at the features of the stock itself. So, it only applies if you have common stock, but if the common stock has puts, calls, mandatory repurchase provisions, or preference features other than dividends, guess what? You're not exempt from 409A, and I'll go into why that's an issue in a minute. And the other thing is, if you are an employee or independent contractor or director or consultant of a parent organization, and you have a subsidiary that's 50% or more owned, and the subsidiary is the one whose stock is being issued, you don't qualify for the exemption. It's just one of those nuances that's frequently missed in an M&A context when you're dealing with acquisitions of a company that becomes a subsidiary of the buyer. We can go to the next slide. So what do you do with Section 409A? First, you take inventory in the context of an M&A deal. You look at employment agreements, retention, change of control, severance, and consulting agreements. Very, very, even more precisely about this, an employment agreement, for instance, might include maybe 5 different 409A types of compensation, and each type of compensation is a separate bucket for the 409A analysis. So it might include a bonus, it might include severance upon termination of employment. It might include reimbursements of business expenses. It might include stock options or equity compensation grants. If it's a partnership, if it's an LLC tax as a partnership, it might include some phantom equity arrangements that could be subject to 409A. There are tons of examples here in which taking inventory is one of the first things you want to do when you're dealing with an M&A transaction. Then we go to something that is not frequently looked at, but really should be, or not as frequently looked at as one might hope and think, earnout and deferred deal consideration provisions. So It's very common these days for a buyer to insist that a portion of the purchase price is going to be subject to holdback. Sometimes it's to support the rep's warranties and covenants in the deal document. Other times it's because the buyer wants to spread some of the risk that the company's valuation is as high as the sellers say it is. And one of the ways to address that is to put a portion of the purchase price at risk and subject it to an earnout, which essentially is performance conditions that have to be satisfied, typically at the company level, in order for deal consideration to be released. It's sometimes, and increasingly, I would say, accompanied by deferred deal consideration that is independent of an earnout condition. So you might have, as an example, if you have a deal in which $50 million is the purchase price, the sellers might get paid $30 million at closing. There might be $15 million in earnout, and there might be $5 million in deferred deal consideration payments. Or that could flip, 5 in earnout and 15 in deferred deal consideration provisions. It really depends on the specific deal dynamics. Now, the reason why you have to look at these issues is ordinarily, if you look at an earnout and deferred deal consideration, you would think that this is all purchase price. It's not compensatory. However, it is not uncommon for the buyer to require, as a condition of the sellers receiving the earnout and deferred deal consideration provisions, the performance of services after the deal closes. Once you add services as a requirement, particularly if the services are substantial, like full-time services over a period of a year or two following the closing date, you've now converted a non-compensatory deal payment into compensation. And then you have to look at whether the earnout and deferred deal consideration provisions satisfy the payment timing and payment form requirements of Section 409A. And one quick point about this, if 409A is violated, either in form, meaning the deal documents, or in operation, the recipient of the compensation, whether it's an employee or an independent contractor or an employee of the buyer who was a shareholder of the seller before the deal closed, that employee and that individual who gets hit with a 409A 20% tax penalty. You would also want to look at an in-the-money stock option or stock appreciation right plan. So the overall exemption is if you set a non-qualified stock option or a stock appreciation right plan with an exercise price equal to fair market value on the grant date, you're not subject to 409A. Again, you have to check those issues regarding the underlying stock and who the issuer is, particularly if the recipients of the awards are at the parent level and the stock is being issued at the subsidiary level. But typically you can structure options and stock appreciation rights to be exempt from 409A. But if they're not, if they're in the money, meaning the exercise price is lower than fair market value as of the grant date, then the exercisability of those options and stock appreciation rights has to comply with the 409A payment rules. So, for instance, they could only be exercised upon a change in control or upon a separation from service, let's say within 12 months following a change in control, or they would have to be exercised by March 15th following the year of vesting. Restricted stock units, same principle regarding deferral features. If there's a possibility that the RSU could be the shares underlying the RSUs could be delivered later than March 15th of the year following vesting, you've got deferred comp. Phantom stock, typically the payment trigger is a change in control and it's cash payments. So typically you don't run afoul of 409A, but one scenario in which you could run afoul of 409A is if you have vesting that precedes the year of the change in control, then it's entirely possible that you can have 409A issues, and you just have to be mindful of navigating them. We can go to the next slide. Penalties for violating. So immediate federal income tax at vesting. At vesting, that's even if payment is not made. That's especially painful if you have a stock option, because you may not be able to exercise for a variety of reasons. For instance, having to pay the exercise price might be too big of a hurdle for you, but you would get taxed on the excess of the fair market value of the stock at vesting over the exercise price. At the time of vesting, that's painful in and of itself. You've got the 20% penalty tax in addition to regular taxes. God help you, if you live in California, you've got an additional 5% 409A tax that tracks the federal rules. And that's in addition to regular income taxes. If you pay late, the IRS charges you premium interest. It's a real issue. And why do we care? Number one, you need to check for tax gross up. In public company deals, you don't see this anymore because the ISSs and Glass Lewis's of the world, the shareholder advisory firms, would issue no vote recommendations for the boards of directors at the annual meetings if you had gross up provisions, particularly full gross up provisions. So you really don't see this in the public company context. And it's really fallen out of disfavor in the private company context because of the cost of it. The other reason why you care about it is because you'll have an unhappy executive if the executive is being retained by the buyer. The last thing you want is for the executive to come back to the buyer and say, "What did you do to me? What did you guys do to me?" So you've got to be mindful of those issues too. We can go to the next slide. All right, Section 83. So this is restricted stock. Restricted stock, as Andy mentioned, is stock subject to a vesting schedule. Typically, there are two types of vesting rules that you can impose. One is substantial services in the future need to be performed. The other is a condition relating to the purpose of the compensation. For instance, you can say achievement of a certain level of earnings, a certain level of EBITDA, something along those lines. Or you can have both. So frequently you have restricted stock that's granted with time and or performance vesting provisions. And the general rule is under Section 83 of the Internal Revenue Code, which applies to restricted stock, 409A does not. Under Section 83, tax applies, income and FICA tax, different statute, but tax applies at the time of vesting unless the employee elects to have tax applied at the grant date. And that's called an 83B election in reference to the section of the Internal Revenue Code, section under which that's available. So why would the executive want to do this? The reason why is because the executive looks at the value of the company. So a startup company or an LLC taxed as a partnership where a profits interest is given and the profits interest has a value of 0 or close to it, the executive is really taking very little to no risk by saying, okay, I'm going to elect to be taxed at the grant date because my tax is going to be 0 or close to it, rather than take the risk of appreciation between grant and vesting and get taxed on the appreciation. The executive also might expect tax rates to increase materially between grant and vesting. And if that happens, all else being equal, you want to pay at the lower tax rates. And typically, you'd want to have a situation, if you're the executive, in which you're relatively sure, all else being equal, that you're going to be around for the period, for the vesting period, so you're not forfeiting the stock. But you don't really see 83B elections made that often unless the value of the stock at the time of grant is zero or very close to zero. We can go to the next slide. And by the way, that exemption, that election needs to be made within 30 days following the grant date. Following the grant date of the stock. Now we get to nonprofit executive compensation, which is its own animal. Nonprofit executive comp has an entirely different set of rules. So with a nonprofit, one of the differences between a nonprofit and a for-profit organization is how deferred compensation is taxed. Under Section 457F of the Internal Revenue Code, deferred compensation is taxed at vesting rather than at distribution, which is the rule for everybody else. So you've got to be very careful when you are structuring deferred comp arrangements for key executives of nonprofits, because you don't want a surprise taxable event at vesting, thinking that, oh, I can just wait until the amounts are distributed. It doesn't work that way, unfortunately. It has to be unfunded, meaning that the executive's entitlement to the deferred comp has to be subject to the claims of the nonprofit's creditors in the event of bankruptcy. Stated differently, if the nonprofit goes bankrupt or insolvent, the executive stands in line like all the other unsecured creditors to get his or her money. And the last thing is you want to structure it so that it's maintained for a select group of management or highly compensated employees. That's the Top Hat plan, to which Andy was referring earlier. And you do this to reduce exposure under ERISA. It pretty much wipes out all of the material ERISA requirements that otherwise would apply to a deferred comp plan for a nonprofit, except for claims review and adjudication of disputes. Things like ERISA preemption, which court does a participant have to go to sue if that ends up happening. The second thing that you want to be mindful of in nonprofit exec comp, mostly an issue for 501c3 nonprofits, and I'll say it again, 501c3 is excess benefit transactions. Essentially, when you pay a key executive compensation that exceeds reasonable compensation, there's a 25% tax on the executive. There's a 10% potential tax on the board members and the officers who knowingly approved that transaction. And the tax on the executive can go as high as 200% if the IRS discovers it before the transaction is unwound, meaning before you go back to what the situation was before the compensation was paid. If we can go to the next slide. So the 10% tax on the board members, there's a cap, which I believe is about $20,000. It's still a pain. No one wants to see that happen. Now, here's the key. There's a rebuttable presumption if the board or the comp committee of the nonprofit hires a comp consultant that issues an opinion that the comp is reasonable compensation. If you do that, then the IRS the IRS can combat that, but it can combat that only if it develops sufficient evidence to show that the comparability data relied upon by the comp consultant is erroneous. And again, that's a high standard. It is very rare that that actually happens if you get a valuation firm of any reputation. And again, it applies mostly to 501c3s. We can move to the next slide. Then the last thing, this section 4960, 21% excise tax on nonprofits. This was added by the Tax Relief Act of 2017, and it applies to pretty much any nonprofit organization. Unlike the other taxes, which we've talked about, 409A and 280G, which are imposed on the employee/service provider, the 4960 tax is imposed on the nonprofit. The nonprofit itself has to come up with the funds. And what does it mean? And when does this apply? It applies if you pay a key executive more than $1 million in any calendar year. The excess of compensation over $1 million, the nonprofit pays 21% tax on it. It also applies to severance akin to a parachute payment under the 280G rules. So if you look at severance, the present value of which equals or exceeds 3 times the average comp for the preceding 5 calendar years, the 5 years ending with the year prior to the year that the severance occurs, you've got the 21% tax on the excess. There's no real shareholder approval exception here that really works. It applies to both 501c3 profits and others. The mitigation strategy, just as it would be for 280G, is to pay larger bonuses in years 4 and 5, for instance, of that 5-year average compensation period. So it's harder to trip the issue of the 3 times average taxable wages and therefore the 21% excise tax. We can go to the next slide.
Adam, I'm just going to interrupt real quick here because we're at the top of the hour. Yep. So I just want to provide the second CLE code. And for those of you who can stick around for a few more minutes, we'll get to the last couple of topics quickly here. But the second CLE code, for those who want CLE credit, on the screen now, 92962. 92962. Thanks. Okay, back to you, Adam.
Thanks so much, Andy. And we can go back a few slides, please. That slide. So the last slide in this section, I believe, substitution/assumption of target awards by the buyer. You see this a lot in in M&A transactions. Here's the key. From a tax standpoint, preserving the economics tends to mitigate risk of adverse tax consequences. It's also good business. And when you do that, you need to review shareholders' agreements, loan documents, plan terms, and you also have to review tax and securities law rules. We can go to the next slide. And speaking of corporate and securities law considerations, a couple of things here. One thing to note is that when stock options are issued, when restricted stock is issued, when RSUs that are either settled in stock or can be settled either in stock or in cash are issued, those are securities under the Securities Act of 1933, and the company can't do it unless there is an exemption from registration under that act. Typically, it's Rule 701 that would apply here, but there are other exemptions that could apply. And here I'm talking only about private companies. There are also Delaware corporation rule issues, corporate law issues. So this comes into play particularly when you have boards of directors who grant stock options or restricted stock or other equity awards to themselves. And the plan document doesn't include language in it that authorizes the board to do so. The argument is that unless the shareholders have approved the grants to the board is violating the business judgment rule, which ordinarily respects all actions done by the board on behalf of the company, absent gross negligence or a major breach of fiduciary duty. But if the board is not getting shareholder approval either at the time the awards are made or in the plan document itself that says the shareholders have approved this number of shares for the board. Then something known as the entire fairness doctrine applies. And that, particularly in a public company context, tends to lead to shareholder derivative suits, and nobody wants those. They can be absolutely nasty. And then, kind of tongue in cheek, beware of the republic. Yes, we do mean California. California has its own set of rules applicable to stock option grants, qualifying under its version of Rule 701. Like it does in a lot of things, California has very specific rules that tend to differ from the rules of other states. You can go to the next slide. Okay, we talked about securities registration exemptions, again, private companies. So common equity compensation securities we talked about. Profits, interest, and LLCs, by the way, taxed as partnerships, those are securities. You need an exemption from registration in order to grant those. You just do. Applicable federal exemptions, 701 is the big one. If you can't get to 701, Reg D, rules 4.1, 4.2, and 4.1.5 under the Securities Act can get you there, but you really need to speak with Securities Counsel to make sure you're not tripping any of those rules. Rule 701 in particular, there have been lawsuits involving 701 and penalties imposed on companies that have inadvertently violated the 701 requirements. The good news is they're mechanical and they're relatively easy to track. You just have to be mindful of what those rules are. Now we can go to the next slide. Okay, Dodd-Frank and exchange rules, public companies only, say on pay and say on executive compensation, parachute payments. These are advisory votes that have been on the books for almost a decade now. The big new rule here was issued by the SEC at the end of 2022. The final clawback rules on compensation payable to executives in the event of financial restatements. And now we can move to the next slide. And we can just skip this, but you can look at pay ratios, another one of the favorites here, CEO pay ratio to general employees. We can move to the next slide. Accounting, the only thing I'm going to mention here is, as lawyers, we're not accountants, but here's the key. There are specific accounting rules under Accounting Standards Codification 718, ASC 718. Bottom line, equity is accounted either as an equity award or as a liability award. If it's a liability award, like a cash settled award, it's materially worse for the company from an accounting standpoint, and it can create issues. So the idea is to go to the company's accountants early and often in an M&A transaction to make sure you're not inadvertently tripping adverse accounting treatment. I think this may be the last slide under executive compensation, which brings us, I think, to the top 10.
Yeah, I think we're gonna have to cut it off here. There's a little bit more information in the slides, which you will get. The items in the ERISA section that is just a few slides. We've already touched on all of them, so hopefully we've adequately covered that. Please feel free to, of course, to reach out to us with any questions. And at the end, when you get the slides, there's a top 10, which we have also covered as well. But just some reminders of the key things to watch for in a transaction. So remember to keep an eye out for a follow-up email, which will include links to those materials. And if we did not get to your question, we will do our best to reach out to you afterwards. So thank you very much for attending, and enjoy the rest of your day.
Thanks, everybody. And look at the top 10. It's cool stuff.